Let's start by understanding how partnerships are treated under Malaysian tax law. Unlike companies, partnerships are not considered separate taxable entities. Instead, the business income is calculated at the partnership level, and then the profits are divided among the partners. This has important implications for how tax allowances such as capital allowances are handled. In this video, we'll break down the key rules, computations, and practical examples to help you grasp how capital allowances work in partnerships. Whether you're a partner or an advisor, this knowledge is essential for effective tax planning. Capital allowances are tax deductions that replace accounting depreciation for tax purposes. They apply to qualifying assets like plant, machinery, and industrial buildings. Instead of deducting depreciation, partnerships claim capital allowances to reduce their taxable business income. This system ensures that the cost of long-term assets is spread over several years, aligning tax deductions with the asset's useful life. Understanding this concept is crucial, as it directly impacts the amount of income available for distribution among partners. Malaysian Income Tax Act 1967 contains several key sections relevant to capital allowances in partnerships. Schedule 3 outlines the types of capital allowances available. Section 33(1) details deductible business expenses, while Section 34 covers deduction rules for plant and machinery. Section 44 provides for special deductions and incentives, including accelerated allowances. Familiarity with these sections is essential for accurate computation and compliance. Calculating capital allowances in a partnership involves several steps. First, you determine the qualifying expenditure for each asset. Next, you calculate the initial allowance in the year the asset is acquired. Then, you compute the annual allowance on the remaining balance. The total capital allowance for the year is the sum of the initial and annual allowances. This amount is then deducted from the partnership's provisional adjusted income to arrive at the adjusted income, which forms the basis for profit allocation. First step is to identify the qualifying expenditure for each asset. This refers to the cost of acquiring assets like machinery, plant, or industrial buildings that are eligible for capital allowances. Only assets used for business purposes qualify. Accurate identification and documentation of these costs are crucial, as they form the basis for all subsequent calculations. Once the qualifying expenditure is determined, the next step is to calculate the initial allowance. This is a one-time deduction allowed in the year the asset is acquired. The rate of initial allowance varies depending on the asset type, but for machinery it is typically 20%. This deduction provides an immediate tax benefit in the first year of ownership. After claiming the initial allowance, partnerships can claim an annual allowance on the remaining balance of the asset's cost. This allowance is spread over several years, with the rate depending on the asset type. For machinery, the annual rate is usually 14%. This ensures that the cost of the asset is gradually written off for tax purposes, matching its useful life. Total capital allowance for the year is the sum of the initial allowance and the annual allowance. This total is deducted from the partnership's provisional adjusted income. The result is the adjusted income, which is the amount available for allocation among partners. This step is crucial for reducing the partnership's taxable income. After deducting the total capital allowance, you arrive at the partnership's adjusted income. This figure is critical because it forms the basis for dividing profits among partners. The adjusted income reflects the true taxable income after accounting for the cost of long-term assets, ensuring a fair and accurate profit allocation. Once the adjusted income is determined, it is allocated among the partners according to the agreed profit-sharing ratio. This allocation is based on the partnership agreement and is done after deducting capital allowances. It's important to note that drawings by partners do not affect this calculation, only the profit allocation is impacted. Let's look at a practical example. Suppose XYZ partnership purchases machinery costing Rm 100,000. The initial allowance at 20% is Rm 20,000, and the annual allowance at 14% is Rm 14,000. The total capital allowance for the year is Rm 34,000. This amount is deducted from the provisional adjusted income of Rm 200,000, resulting in an adjusted income of Rm 166,000. This adjusted income is then used as the basis for dividing profits among the partners. Recap: capital allowances are always computed at the partnership level, not by individual partners. The divisible income is reduced by the total capital allowances before being allocated. Partners share profits after the deduction and drawings are not affected. Special incentives such as accelerated allowances may apply depending on the business or asset type. Some partnerships may qualify for special incentives, such as the Accelerated Capital Allowance (ACA). These incentives allow for faster write-off of asset costs, reducing taxable income more quickly. Eligibility depends on the type of business and the nature of the asset. Always check the latest tax guidelines to see if your partnership qualifies for these benefits. Formula for adjusted income is straightforward. Adjusted income equals provisional adjusted income minus capital allowances, which include initial, annual, and any accelerated allowances. Divisible income is then calculated by subtracting partners' salaries, interest, or other appropriations from the adjusted income. This ensures a fair and transparent allocation of profits. Capital allowances play a vital role in partnership tax planning. By replacing depreciation, they ensure that tax deductions are aligned with the actual use and wear of business assets. This not only reduces the partnership's taxable income, but also ensures that each partner's share of profits reflects the true economic position of the business. One common mistake is calculating capital allowances at the individual partner level instead of the partnership level. Another is failing to properly document qualifying expenditure or missing out on special incentives. Always ensure that calculations are accurate and in line with the partnership agreement to avoid disputes and compliance issues. Accurate computation of capital allowances is essential for tax compliance. Mistakes can lead to underpayment or overpayment of taxes, penalties, or even audits. By following the correct procedures and maintaining proper records, partnerships can ensure smooth tax filings and avoid unnecessary complications. The partnership agreement plays a crucial role in determining how profits are shared after capital allowances are deducted. It should clearly state the profit-sharing ratio and any special arrangements regarding salaries, interest, or appropriations. This ensures transparency and helps prevent disputes among partners. It's important to distinguish between drawings and profit allocation. Drawings are amounts withdrawn by partners during the year and do not affect the calculation of divisible income. Only the allocation of profits after deducting capital allowances determines each partner's taxable share. Proper documentation is vital for claiming capital allowances. Keep detailed records of asset purchases, calculations, and partnership agreements. This not only supports your tax filings but also provides evidence in case of audits or disputes. Good record keeping is a best practice for all partnerships. Summary: capital allowances are a critical part of partnership taxation in Malaysia. They replace depreciation, are computed at the partnership level, and ensure fair profit allocation. Understanding the rules, following the correct computation steps, and maintaining proper documentation are essential for compliance and effective tax planning. With these insights, partnerships can optimize their tax position and avoid common pitfalls.